November 28th, 2025. While silver hit $56.72 per ounce during the CME cooling failure, something else happened that should have triggered emergency meetings in every central bank globally. JPMorgan quietly reclassified 13.4 million ounces from registered to eligible status in COMEX vaults. Let me put that in perspective. JPMorgan just removed 9% of deliverable silver from the market during peak physical demand. Not sold it, not moved it, simply changed its classification so it could no longer be delivered against futures contracts. I kept asking myself, why would America's most powerful bank pull deliverable silver off the table precisely when the market was screaming for physical metal? Then I started mapping JPMorgan's silver positions over the past 15 years, and what I found was the most audacious financial reversal in precious metals history. A strategy so patient, so systematic, that it makes the Hunt brothers look like amateur speculators.
Here's what caught my attention. In 2008, JPMorgan acquired Bear Stearns and inherited massive short positions in silver. For years, they were apparently on the wrong side of every silver rally. 2020 brought a $920 million settlement for precious metals manipulation, the largest penalty in COMEX history. But something changed after that settlement. Instead of continuing the manipulation game, JPMorgan did something unprecedented. They flipped sides entirely. Since 2011, market observers estimate JPMorgan has accumulated between 650 to 750 million ounces of physical silver. If those estimates are accurate, that represents roughly 25% of all above-ground silver in investment-grade bars. More than the Hunt brothers ever held. More than entire nations' strategic reserves. They didn't acquire this silver through dramatic market purchases that would spike prices. They accumulated quietly, systematically, using their privileged position as a primary dealer to absorb metal during every market weakness. And now, with silver breaking all-time highs and COMEX inventories at critical levels, JPMorgan sits on what industry insiders call the silver bomb. But this isn't just about one bank accumulating a precious metal. This is about institutional positioning that suggests they know something about silver's future that the rest of the market hasn't figured out yet. When banks accumulate massive positions in monetary metals, they're not speculating. They're positioning for systematic change. And when the largest bank in America positions for systematic change in silver markets, everyone else should be paying attention.
The COMEX cooling failure on November 28th wasn't about server temperatures. It was about a system under stress from physical demand that exchanges can't meet. And during that stress test, JPMorgan moved to protect their silver from delivery obligations. That tells me everything about where this is heading. The Hunt brothers tried to corner silver using leverage and borrowed money. They failed because they fought against the system. JPMorgan learned from that lesson. Instead of fighting the system, they became the system. And now they're using that position to accumulate more silver than any private entity in modern history. Here's what makes this different from every previous silver accumulation. JPMorgan isn't trying to manipulate prices higher. They're preparing for prices to explode naturally due to supply constraints and industrial demand. They position themselves to profit from inevitability rather than create artificial scarcity.
And the timing is perfect. Industrial demand for silver is exploding, from solar panels, electric vehicles, and data centers. Mine production peaked in 2016 and hasn't grown. COMEX inventories are draining at rates that make delivery obligations impossible to fulfill. When the physical silver shortage becomes undeniable and paper markets break down, JPMorgan will control more silver than some countries produce annually. They won't need to manipulate anything. They'll just need to wait for mathematics to work. The November 28th reclassification was a signal. JPMorgan is preparing for the final phase of a 15-year accumulation strategy that could make the Hunt brothers' silver squeeze look like a warm-up act. And this is where the pattern becomes dangerous. The story begins with a financial crisis that changed everything. March 16, 2008. JPMorgan acquired Bear Stearns for $2 per share in a Federal Reserve orchestrated rescue. Along with Bear Stearns' assets, they inherited something toxic: massive short positions in precious metals markets. For the next 12 years, JPMorgan became the most sophisticated precious metals manipulation operation in financial history. They didn't just suppress silver prices, they turned suppression into a science. The manipulation techniques were systematic and well documented. Spoofing, placing large orders they never intended to execute to create false market signals. Layering, stacking multiple orders to create artificial supply or demand. Quote stuffing, rapid order placement and cancellation to destabilize algorithmic trading systems. But here's what most analysis misses. JPMorgan wasn't manipulating silver prices for profit. They were manipulating prices for survival. Those inherited Bear Stearns short positions represented potentially unlimited losses if silver prices exploded. Every dollar silver gained cost JPMorgan hundreds of millions. Suppression wasn't market manipulation. It was risk management for positions they never wanted to hold. The scale of their operations became legendary among traders. During London trading hours, massive sell orders would appear whenever silver approached technical resistance levels. During COMEX futures rollover periods, coordinated selling would hammer prices precisely when physical demand was strongest. Ted Butler, the precious metals analyst who tracked JPMorgan's activities for over a decade, estimated they were short 200+ million ounces at their peak exposure. That's roughly 8% of annual global silver production held in paper short positions by a single institution. The regulatory response was predictably ineffective. CFTC position limit discussions stretched for years without meaningful implementation. Whistleblower complaints were filed and ignored. Academic studies documented the manipulation patterns, but enforcement remained non-existent. Until 2020 changed everything. September 2020. JPMorgan settled with regulators for $920 million in precious metals manipulation charges, the largest penalty in COMEX history. But more importantly, the settlement marked the end of their suppression campaign and the beginning of their accumulation strategy. Here's the genius of what happened next. Instead of fighting silver's inevitable rise, JPMorgan positioned to profit from it. They began systematically covering their inherited short positions while simultaneously accumulating physical metal. Every market weakness became a buying opportunity. Every investor selling during COVID panic became a JPMorgan accumulation event. The accumulation wasn't random or opportunistic. It was systematic and patient. Market observers tracking warehouse movements, ETF flows, and COMEX delivery patterns estimate JPMorgan absorbed 50 to 80 million ounces annually from 2011 through 2024. Ted Butler's analysis suggests JPMorgan now holds 675 million ounces of physical silver. If accurate, that's more silver than most countries produce in a decade. More than the strategic reserves of entire nations. More than the Hunt brothers accumulated at their 1980 peak. But unlike the Hunt brothers, JPMorgan's accumulation strategy was invisible to markets. They used their privileged position as a primary dealer, their access to Fed facilities, and their global network to acquire metal without triggering price discovery. The transformation from suppressor to accumulator represents the most sophisticated long-term trade in precious metals history. For over a decade, they suppressed prices while systematically acquiring physical metal at artificially low levels. And now they sit on the largest private silver hoard in modern history, just as supply deficits, industrial demand, and monetary debasement create perfect conditions for explosive price appreciation. This wasn't market manipulation. This was market preparation. JPMorgan spent 15 years positioning for a silver market break that they knew was mathematically inevitable. Industrial demand growth, declining mine production, and monetary system instability created conditions where silver prices must eventually explode. Instead of fighting that inevitability, they positioned to profit from it. And now, with COMEX inventories at critical levels and physical demand exceeding supply for 7 consecutive years, their patience is about to be rewarded. The question isn't whether silver prices will explode. The question is whether JPMorgan's accumulation strategy will amplify that explosion into the largest precious metals profit in banking history. The mechanics of JPMorgan's silver bomb are brilliant in their simplicity. They control supply at the exact moment demand is exploding. COMEX vault data reveals JPMorgan holds approximately 169 million ounces in eligible silver, roughly 40% of total exchange inventories. But here's the key. Eligible silver isn't available for delivery unless JPMorgan chooses to make it available. November 28th's reclassification removed 13.4 million ounces from registered status. That's not liquidation, it's strategic positioning. JPMorgan is hoarding deliverable silver precisely when futures markets need it most. Current COMEX registered inventories sit at 113 million ounces. Open interest represents 244% of available supply. If even half the contract holders demand delivery, the exchange faces systematic failure. JPMorgan's strategy exploits this imbalance perfectly. They accumulated massive physical positions during 15 years of price suppression. Now they control supply release during the most critical shortage in silver market history. The timing couldn't be better. Industrial demand is consuming 1.1 billion ounces annually, while mine production stays flat at 880 million ounces. Above-ground stockpiles drain by 220+ million ounces yearly to cover the deficit. Solar panel manufacturing alone requires 230 million ounces annually, more than Mexico's total production. Electric vehicle silver consumption is doubling as automakers transition to solid-state batteries. Data centers, 5G infrastructure, medical devices, every growth sector increases silver demand. But supply response isn't coming. Primary silver mines represent just 30% of production. Most silver derives from copper, lead, and zinc mining byproducts. When base metal prices stay weak, silver supply doesn't respond to silver demand. JPMorgan positioned for this supply crisis years before it became visible. Their accumulation strategy anticipated industrial demand growth, supply constraints, and monetary debasement, creating perfect storm conditions for silver. The Federal Reserve's monetary policy amplifies JPMorgan's positioning advantage. 12 years of quantitative easing and near-zero interest rates destroyed real returns on bonds and savings accounts. Investors searching for inflation hedges increasingly turn to precious metals. When paper currency loses purchasing power, physical assets gain relative value. Silver's dual role as industrial commodity and monetary metal creates compounding demand from both sectors simultaneously. JPMorgan's bomb mechanism exploits this convergence. Industrial users need silver, regardless of price, for technological applications with no substitutes. Investors want silver as monetary protection against currency debasement. Both demand sources compete for supply. JPMorgan controls. The November 28th CME outage provided the perfect cover for their positioning adjustment. During market stress, when prices spiked to $56.72, JPMorgan quietly moved to protect their inventory from delivery obligations. Market observers tracking warehouse movements estimate JPMorgan's total physical holdings between 650 to 750 million ounces across eligible COMEX silver, allocated storage, and private vaults. If accurate, they control more silver than annual global production. When supply shortage becomes undeniable and paper markets break down, JPMorgan won't need to manipulate prices higher. Market forces will do the work, while they control the physical metal desperate buyers require. The bomb's fuse is already lit. COMEX drainage accelerates monthly. Industrial demand grows quarterly. Mine production stays flat annually. Mathematics guarantees explosive price discovery when physical shortage meets paper promises. JPMorgan positioned for inevitability, not speculation. And inevitability is arriving faster than markets expect. January 2026. The silver bomb explodes, not through manipulation or market corners, through mathematics. When industrial demand exceeds mine production for 8 consecutive years, while JPMorgan controls 25% of investment-grade silver, price discovery becomes violent. The Hunt brothers failed because they fought the system using leverage. JPMorgan succeeded because they became the system and used patience. 15 years of systematic accumulation during suppressed prices created the largest private silver position in modern history. Now they wait for inevitability. COMEX inventories drain monthly. Industrial demand grows quarterly. Supply response won't arrive for decades. When registered silver falls below 50 million ounces, possibly by March 2026, delivery failures cascade. JPMorgan positioned perfectly for this breakdown. They control physical supply when desperate buyers discover paper promises can't be converted to metal. November 28th was their final positioning adjustment. They're prepared for systematic market failure that forces silver price discovery beyond historical precedent. Smart money recognizes the setup. America's most sophisticated bank spent 15 years accumulating a monetary metal just as supply deficits guarantee explosive appreciation. This isn't speculation. This is pattern completion. Your choice. Understand what JPMorgan understood years ago, or discover why America's largest bank positioned for the biggest precious metals trade
in banking history.
The silver bomb's timer is running. JPMorgan knows exactly when it detonates. The question is whether you'll be positioned before or after the explosion. When one institution controls this much silver during a physical shortage, what do you think breaks first? The paper market, price discovery, or trust in the system itself? Let me know your view below.